So our global study splits the drivers of the economy for insurance into four different areas. Demographics, and we saw Warwick chat about that. Specifically in Australia, we do have positive growth. That's going to attribute some share of 1 to 1.5% GDP growth. And the theme today is how are we going to deliver to the growth expectation of our shareholders and stakeholders when firstly GDP growth is slow. The second mega trend is the environment, both in respect of consumer sensitivity for the environment, but also in here we put the economics. And in this space, a key issue for general insurers are the low yields we can get from our asset side. If I look at the last decade, it's been a significant theme of fixing the liability side, making sure our underwriting disciplines are strong, our pricing is accurate, and that we respond when risks change. But we have, as a result, ended up with fairly lazy balance sheets from an asset side. We're fairly conservative in respect of the assets we invest in. We have for some time been able to get reasonable yields from bonds to drive the return that we need from the assets we have to hold, but those yields are not high enough to support the margins that we currently have, and I think we're going to need to look at that aspect. Social values, behaviours and ethics I'll touch on next. The way we engage with our consumers is changing. In the past, we advertised, we told the story, and our consumers absorbed that message. Now, with the advent of social media, it's a conversation. If we advertise, our consumers now believe that we owe them something, and they expect us to be ethical in a way that we didn't have before. If they buy from us, then they feel we owe them big time. If we disappoint them, they will share their experience. Similarly, though, they themselves hold themselves to account. If we surprise them, if we deliver on our promise, they will share that too. Our brands now are in play, and they're an open part of the daily discussion. I'm going to touch on that with some slides from some recent social media studies that we've done. I'll come back to technology. I didn't quite have time to put into the slides today some of the disruptive technologies that are impacting other businesses. But the adage is this, that technology happens slowly before it happens quickly. And I think the statistics were something like the number of Netflix users in Australia within the first week went from 20,000 who managed via routers to register to over 400,000 in just a week. So what's happening if you're at Foxtel and you're looking at your projected growth when you've got this sort of digital disruption coming through? And I think we as an industry have been very slow to embrace the opportunities that come from technology. And now, equally for some of us as staff, technology is quite a threat to us. But as organisations, as insurers, we really need to embrace this. And if we don't embrace the opportunity from technology, our competitors and new competitors will. So I've just captured here some of the drivers for change that I'm going to come back to when I get to the end of my slides. I mentioned low yields. I should also mention that we're extremely well capitalised as an industry. If we look at the ratio of prudential capital to our premium, or our multiples of capital to prudential capital requirements, are all extremely strong. What I can say as an actuary, when I look at companies' risk appetites, many organisations are sitting at or above the top of their target capital range. And they're sitting there, as Warwick said, everyone's looking for where to invest. And in the event that they have to take risk to invest, I think a key issue we have is that the individuals that need to make those decisions are reticent to invest. In many respects, it's easier at a personal level not to take that risk because you won't be criticised for blowing the capital on the wrong investments. But this capital is building. We're making more and more profit. We've got more and more retained capital. For Australia, we're not seeing the full impact of that yet, but we're seeing a softening cycle in the commercial insurances. In global reinsurance, it's almost at a crisis level. There's so much reinsurance capacity globally. we're seeing some fundamental shifts and changes. We saw recently, for example, Berkshire Hathaway come in with its deal with IAG. We're seeing other reinsurers seeking a takeout bid in respect of moving away from a panel reinsurance type structure to offering 100% capacity on different programs. We're seeing well-capitalised insurers from overseas, Progressive, for example, coming in and seeking new markets. And this is a fundamental threat to our operations here, or we might embrace it and see it as an opportunity. But that capital around the world is going to seek a return. And in Australia and insurance at the moment, it's still pretty good. Demographics, I'll touch on two themes. The first is that the Gen Ys are coming on stream. What does that mean? I'll tell you as we get to that. New migrants provide opportunities. But again, the message here is we need to listen to these consumers. We need to learn about them, and we need to engage with them on their terms. And if we don't, they'll find service providers that do. Risk is also a key issue for us. Ultimately, we earn our profit as part of the bandwidth on the risk that we pool or transfer. From time to time, we can maintain a knowledge disparity on the level of that risk and make supernormal profits. And I believe to some degree, by design or accident, we did this in the wake of tort reform. We had years of supernormal profits in respect of that line of business, but they are starting to come to an end now that we're more than a decade past tort reform, and the so-called threat of tort reform unwind hasn't materialised. What we're going to see is the substantial de-risking of motor vehicle use. I'll touch on that, and its significant threat, particularly for the big boys in this industry. On the other hand, some risks are growing, particularly natural risk conurbation. We are a nation that loves the coast. Bernard has a great slide, I haven't used it today, that shows how more and more of our property assets are built in very high-risk areas on the coast and in flood regions. The question is this a risk as an insurance market that we can make profit on? I say it is, while the reinsurers are overrun by capital and excess capital, but longer term I'm not sure. And technology I've touched on.